Liabilities. Accounts payable represent the amounts a company owes to suppliers for goods or services received on credit. It is classified as a current liability because the company must settle these obligations within a short period, typically 30 to 90 days. This account is one of the most common liabilities in any business, especially those that purchase raw materials, merchandise, or professional services on credit. The importance of accounts payable lies in its role in managing cash flow. Paying suppliers too quickly can reduce available cash, while paying too late can damage relationships or lead to penalties. Businesses must balance these factors carefully to maintain liquidity and good credit standing. According to the accrual basis principle, expenses are recorded when incurred, not when paid. Therefore, even if the company has not yet disbursed the money, the obligation must appear on the balance sheet. Proper control of accounts payable ensures that financial statements reflect all current debts accurately. Companies often negotiate credit terms with suppliers, such as discounts for early payment or extended due dates. These decisions affect cash management and working capital. For example, taking advantage of early payment discounts can save money, but only if the company has sufficient liquidity. From a decision-making perspective, tracking accounts payable helps managers forecast cash needs, avoid late fees, and maintain supplier trust. Poor management can lead to strained relationships or even supply chain interruptions. Example, if a business purchases $3,000 of materials on credit, that amount is recorded under accounts payable until the company pays the supplier. Salaries payable represent the amount of money a company owes to employees for work they have already performed but has not yet been paid. It is classified as a current liability because these payments are typically settled within days or weeks. This account is essential for any organization because salaries are one of the largest recurring expenses in most businesses. According to the matching principle, expenses must be recognized in the period they are incurred, even if the payment is made later. Therefore, at the end of an accounting period, companies must record salaries payable to ensure accurate financial reporting. The importance of this account extends beyond compliance. Timely payment of salaries is critical for employee satisfaction and productivity. Delays can damage morale and affect the company's reputation. Furthermore, failure to manage this liability properly may result in legal consequences or penalties under labor laws. From a financial management perspective, companies must plan cash flow to ensure enough funds are available on payroll dates. This is why many businesses synchronize payroll cycles with revenue inflows to avoid liquidity issues. For decision-making, salaries payable provide insights into labor costs and help managers plan workforce budgets, overtime policies, and hiring strategies. Example, if employees have earned $10,000 in wages by the end of the month, but payment will be made next week, this amount is recorded under salaries payable. Taxes payable represents the amount of taxes a company owes to the government for obligations such as income tax, sales tax, payroll tax, or other statutory levies that have been incurred but not yet paid. It is generally classified as a current liability because these payments are typically due within the company's normal operating cycle or within a year. The accurate recording of taxes payable is essential for legal compliance and adherence to accounting principles like the full disclosure principle, which requires companies to present all significant obligations in their financial statements. Proper disclosure ensures transparency for investors, creditors, and regulators. Failure to account for taxes correctly can lead to penalties, interest charges, audits, legal disputes, and even business closure in severe cases. This account also reflects the company's fiscal responsibility and ability to manage its cash flow. High tax liabilities may indicate strong profitability, but also require strategic financial planning to avoid liquidity problems. Many companies create tax reserves to ensure sufficient funds are available when payments are due, reducing the risk of non-compliance. From an operational perspective, taxes payable impacts budgeting, dividend distribution, and investment decisions. For example, a company facing significant tax obligations may choose to delay certain capital expenditures or expansion projects to prioritize timely tax payments. Example, if a company determines it owes $15,000 in income tax for the current quarter but has not yet paid it, this amount is recorded under taxes payable. When payment is made, the liability decreases and cash is reduced accordingly. Unearned revenue represents money that a company receives from customers for goods or services that have not yet been delivered or performed. It is classified as a liability because, until the company fulfills its obligation, it owes a product or service to the customer. Recording this correctly ensures that the financial statements reflect true obligations and do not overstate income or profits. This account is governed by the revenue recognition principle, which requires that revenue be recorded only when it is earned. Therefore, even if cash has been received, the company cannot recognize it as revenue until the service is provided or the product delivered. This principle ensures that financial reporting is accurate and consistent over time, allowing investors, creditors, and management to make informed decisions. Proper management of unearned revenue is crucial for cash flow planning and operational strategy. Companies with high unearned revenue, such as subscription-based services, software providers, or airlines, must have the resources and capacity to deliver services in the future. Misreporting this account can lead to financial misstatements, legal issues, and loss of credibility with stakeholders. Example, if a gym receives $1,200 in advance for a 12-month membership, the amount is initially recorded as unearned revenue and then gradually recognized as income each month as the membership services are delivered.
Notes payable represent formal written promises to pay a specific amount of money at a future date, often with interest. Unlike accounts payable, notes payable are more formal and usually involve borrowing from banks or financial institutions. They can be classified as current or long-term liabilities depending on the due date. This account is important because it provides businesses with access to financing for expansion, equipment purchases, or working capital. However, it also creates a legal obligation to repay both principal and interest, which affects the company's financial health. According to the cost principle, the note is recorded at its present value, and interest is recognized over time following the matching principle. Businesses must also disclose these obligations in financial statements to provide transparency to investors and creditors. Managing notes payable requires planning, because missing a payment can damage credit ratings and result in penalties. Companies often negotiate favorable terms, such as lower interest rates or extended repayment schedules, to reduce financial pressure. Example, if a business signs a $20,000 loan, agreement payable in 1 year at 8% interest, the amount is recorded under notes payable.